Excuse me, sir.
Jesus. Jimmy, what are you doing barging in here like at the goddamn SEC?
I'm sorry, sir, but JRY just reported and it's down 50% and is basing for another breakdown.
Wait, what are you talking about? That JRY doesn't report until today AMC.
No, it was today BMO.
Oh, fuck me. Come on. Richie, get up.
I need all platforms up, Sterling, E-Trade, toss. Get them all up right now.
Already done, boss.
Looks like the breakdown triggered already. Okay, this is what we're gonna do. We're gonna wait for a secondary entry, and on the trigger, Richie, I need you to kill the position, and Ginny, I want you to short it. We're gonna flip this thing. Okay, the bar's about to close in 5, 4, 3, 2, 1. Okay, here's the trigger, flip it. Did you hear what I said? Short it. It's on an uptick, sir.
Well, fuck the goddamn hockey, Jimmy.
I'm trying. It's dropping. 60%, 65, 70. It's gone. Here are some basic trading lingos I use all the time, starting with going long and short. Going long means I'm buying a stock because I believe the price is going higher, and going short is the exact opposite, where I'm taking a position where I profit if the price goes lower. How does that work? Let's say I want to make money selling a PlayStation 5, but I don't have one. So I decide to borrow my friend's and I sell his on eBay for $400 because I think the price is going to drop. And sure enough, the PS6 comes out, making the PS5 cheaper. So I buy one back for $200 and return the PS5 to my friend. So I was able to make money on the PS5's price dropping. So when I short, I'm borrowing shares to sell at a higher price, to buy back those shares at a lower price, and return the borrowed shares, which is known as covering. Just like when I buy to hopefully sell at a higher price, when I'm shorting, I'm hoping that I will cover at a lower price, so I'm covering those borrowed shares. And where my price is getting executed is known as the fill price. If I put out a buy order for a stock and it fills me at the exact price or even cheaper than I wanted, I consider that getting a good fill. But if it filled me at a much higher price than what I wanted, I would call that getting a bad fill. And that difference is known as the slippage. Slippage is the amount I lose when I get filled at a higher price than what I wanted to buy, or filled at a lower price than what I wanted to sell. For example, if I have an order out to buy JRY at $24 and it fills me at $25, that means I got $1 slippage. I paid $1 more than what I wanted to, so I got a bad fill. This can happen depending on the type of order I'm using, especially on spready stocks. In the stock market, the buyers bid the price that they're willing to pay for the shares, and the sellers offer or ask for the price that they're willing to sell. The spread is the difference between the current best bid and ask price. So if the current highest bidder is at $9 and the current cheapest seller is sitting at $10, that is a $1 spread. I would say, Jimmy, that is very spready for a $10 stock. So what causes these big spreads on stocks? Well, one issue could be the liquidity. Liquidity measures how easily I can buy or sell shares of a stock without affecting the price. There's only a finite number of shares available for us to trade in each stock, and every stock has their own number of shares available. This total is known as the float. So if there's little to no activity, I may not be able to get the amount of shares I want at the price I want. Because let's say I want to buy 1,000 shares of JRY at $24, but only 100 shares are available at that price, and the next cheapest price the sellers are asking for is $27, I would say that is not very liquid. Versus having tens and thousands of shares available, not only at 24, but also 24.01, 02, 03. So in that case, I would say that stock is very liquid. And this little box that gives this information is called a level 2. So one way to tell is to see what kind of volume it's doing. Volume is an indicator that shows exactly how many shares have been traded within a time frame. So if I come across a stock that I want to day trade and I see that it hasn't done much volume, I can expect the spread to open up once it starts to get moving. I may also refer that to being too thin to trade, thin meaning low in volume, because if only a couple of hundred shares are being thrown around, may not be as competitive in price as, let's say, millions of shares being traded. Another cause of bigger spreads may come from a rise in volatility. Volatility measures how wild or controlled a trading activity is. If I take a rowboat out to a lake, I can expect the waters to be less volatile than if I were to take one out to the middle of the ocean, because the ocean is much more unpredictable with the waves and the weather. That can put me in a bad situation very fast. So if I say, Jimmy, this stock is way too volatile, let's sit this one out, means the price is fluctuating way too rapidly for my taste. it's too unpredictable. So the price can get jumpy, meaning it flips and jumps around the price because it's moving so fast. So it almost becomes this game of throwing a dart, but the board is fucking teleporting around. And I may see these types of rise in volatility in stocks that are crashing or gapping. A crash is when a stock is just completely falling apart. Everybody's panic selling out for whatever reason, and it's causing the price to drop a significant amount in a very short time frame. And if a stock drops 10% or more in a single day, they can be placed on a short sale restriction, or also known as the uptick rule, for that day and the following day before this restriction is lifted off. This means I can only get filled on my short orders if someone is buying it. It has to uptick. And they made this rule in the hopes of preventing a stock from just completely cannonballing its way down. That one's more of a swimming term. And if a stock drops 10% or more in 5 minutes, it can actually get halted. A halt is when the exchange literally halts all trading activity for a stock. No one can buy or sell the halted stock during this time. And it doesn't necessarily have to be to the downside. This could be a 10% move in either direction within those 5 minutes. And the halt lasts about 5 minutes or more. And this is also known as the volatility halt, or the proper term, some shit Jimmy would say, is the circuit breaker halt. Because a stock doesn't necessarily have to move for it to get halted. It can also get halted on pending news or news being released. So now I know what happens during a crash. Now let's talk about gaps. A gap is when a stock's price opens higher or lower than the previous day's closing price. So if yesterday a stock price closed at $100, but today it opened lower at $80, it would create a price gap on the chart. The cause can be from news or a company reporting earnings. Whatever the catalyst is, it can make the price open higher or lower. Fading the gap is when I'm looking to play in the opposite direction of the gap. So if a stock gaps down a significant amount, I'm looking to buy to the upside to play in the opposite direction. To where? Maybe the gap fill. Gap fill is simply expecting the stock to fill back into the price it gapped from. Now, there are certain gaps that may be mistaken for real gaps, like a buyout. A buyout is when a company gets acquired, so the stock gaps to the price it got bought out for, so it didn't necessarily trade into that price. It's just opening at the price the deal was made. There's also a stock split. This is when a company increases the number of shares available to trade, or remember, also known as the float, to reduce the price of their stock. So for example, let's say a stock costs $5 per share. So this represents one share. But if the company does a split and changes this $5 per share to, let's say, $1 per share, well, now I have 5 shares worth $1 each, and the value itself didn't change. This is still worth $5. I just did a 5-to-1 split. We saw Nvidia do this recently with a 10-for-1 split. So it's a way to reduce the price to make it more affordable to its investors without changing its actual value. So some platforms would show that big gap in price, but should get adjusted within a few days. Companies can also do what's called a reverse split, which is just the opposite. So here I'm adjusting 5 $1 bills to just a single $5 bill. Mostly penny stocks do this to kind of artificially bump up their stock price to avoid getting delisted. So splits do not affect the value of the company, but secondary offerings do. So whenever a company goes public for the first time, they call it an IPO. Initial public offering. This is the first time they make available so that anyone can buy or sell a piece of their company, and they do this so that they can raise money. So they issue an X amount of shares for the first time at a starting price, and then as time goes on, a company may decide to issue even more shares to raise even more money, and that is known as the secondary offering. And it's not really looked at as a positive event because it's like, bro, why do you need more money? And the problem with issuing new shares is, let's say there were originally 10 million shares floating around to trade, and they decide to create another million out of thin air and throw that into the pool. Well, this would dilute the value of its current shares. There's also non-dilutive secondaries, which is where they issue existing shares. But either way, they usually price these things on sale lower than its current value to attract new investors. So on the chart, it may show it gapping to that new sale price. Another one that can be mistaken for a real gap are ADRs. ADR stands for American Depository Receipts, and these are companies that are primarily traded overseas in the foreign exchanges and not the US market. And they created these ADRs so that me and everyone else in the US can still get in on the action. And what's happening is, because it's primarily trading in that country's market, depending on the time zone, for us, it's just opening at the price it's been trading at. So not a true gap, and it's actually pretty noticeable on a chart. It'll show a stock gapping all the time without the price really moving any significant amount. And then finally, there's dividend stocks. Some companies like to give out cash throughout the year to whoever owns some of their shares as kind of a thank you for fucking with us. Now, I do have to own these shares prior to the ex-dividend date to qualify to get paid, but on the distribution day, it will have a gap down on the chart, but it's just dropping the amount it's paying out to its shareholders. All right, rapid fire time. Scalping is the shortest form of trading. It's just a quick in and out trade. ETB, HTB, and NTB. So when I short, remember that I'm borrowing shares. So ETB stands for easy to borrow, meaning plenty of shares are available to borrow. HTB is hard to borrow. They may need to locate the shares for me to borrow, which may cost some fees. So always got to be mindful of what those fees are. NTB is nothing to borrow, meaning we're sold out. No shares are available. Bullish is having a positive view on price. Price is very strong and believing it'll go higher. Bearish is the opposite, having a negative view on price where price is very weak and believing it'll drop lower. Support is an area in price where it's holding up, almost like a floor where price bounces off from. And resistance is an area in price where it's being rejected, almost like a ceiling where it has a hard time breaking through it. Target is a price point I'm looking to take profit if it goes in my favor. And stop or stop loss is where I'm looking to exit my position if it doesn't go in my favor. Buying power is the amount of cash I have available for buying and shorting. And earnings, BMO and AMC. So every company has a data reports how they're performing to be transparent with us, the investors. So BMO stands for before market opens and AMC is after market close. And this is important to know because if I own shares and want to make any adjustments prior to the reports or even get in, for BMO, I would have to make them prior to the date. Whereas if it's AMC, I'll have an extra trading day to do it since it reports after the market closes that day. So those are some basic ones I use. Obviously, there's a lot more, but if you enjoyed it, make sure to hit that like button, especially for that Oscar-worthy skit. And who knows, maybe I'll bring back Jimmy and Richie and we'll do a part 2. But for now, as always, I appreciate you being here. I hope to see you on the next one. Peace.